Why would people want to come borrow money or borrow or lend money to a DeFi project? Now, this is it. When you go to borrow money from a DeFi project, let's say you have one Bitcoin, and the equivalence of what one Bitcoin is as of today, let's say $10,000. If you decide to have one Bitcoin and you have a need for $5,000, you have a choice, either to sell up your entire one Bitcoin to raise the money you need, or you have a choice to keep that one Bitcoin as collateral. Now, in a traditional banking system, if you want to borrow, you need a collateral. You come with, let's say, your house or some landed property or document, you keep it as a collateral, and then you're able to borrow. But the process is a little bit rigorous when you compare it to what DeFi have come with. Now, what will DeFi do? Your one Bitcoin, you can keep it as a collateral. Borrow the $5,000 you need, because as of today, your one Bitcoin is $10,000. Borrow the $5,000 that you need. Keep your one Bitcoin as a collateral. Use the $5,000 you've borrowed from the DeFi project. Go and execute whatever you want to execute. Come back, let's say 1 month later, 2 months later to pay back. Now, there are high chances that by the time you come back 2 months later, the price of what one Bitcoin is, because after that time it might be $10,000. The price of what one Bitcoin is will most likely be, let's say, $20,000 or $15,000. So if it's, let's say, $20,000 2 months later, you have a choice of coming back and returning the $5,000 which you had borrowed about 2 months ago, right? And then you collect back your one Bitcoin, which is now worth around $20,000. That's the concept. But when you bring back the $5,000, you also bring some form of interest. The interest is not as high as in terms of, when I use the word, the interest is not as high as what traditional bank would have charged you. And apart from that, those who provide their own liquidity, because the $5,000 you borrow came from somebody or came from some group of persons who have put their money into that pool. And now the interest will now be shared among all those who provide their liquidity within that particular pool. Now, to encourage people to deposit or put more of their money into that pool, so that that pool of that DeFi project can have enough liquidity to lend as much money as possible to many people or many institutions, they increase the interest rate for you who would keep your collateral. So you can imagine where a traditional bank is giving you somewhere around 5 to 10%, and the DeFi is telling you, come and put your money into it, and we'll provide you 20%. By default, you want to earn more value for your money, you will naturally put your money into that particular DeFi. The good thing about DeFi is that you can wake up at any point in time, put your money into the DeFi pool, pull your money out. Now, when you're pulling your money out, you pull your money out alongside with the interest it has generated between the time when you started and the time when you're pulling your money out. Now, unlike in a traditional banking institution, if you put your money in a fixed deposit within a tenor, if you want to pull it out before the time that you've agreed, you will be penalized. Not that your money will not be returned back to you. Part of the money will be returned back to you, but you could be penalized and you might lose a fraction of what you probably would have gained. But in the case of DeFi, that's not the situation. You can put your money now into a DeFi pool. 1 day later, you see another DeFi pool giving you better return. You can pull it out, and then you put it in a different one. Now, the most common one you probably must have heard before now, the likes of Compound, Lend, Ava, MakerDAO, and all those are popular ones. Now, what are they doing? Now, let's say Compound is here, Ava is here, Lend is here, all DeFi A, DeFi B, and DeFi C. You have a choice of putting, let's say, your one Bitcoin into the pool, worth around $10,000, into the pool of DeFi A. If in a few minutes later, you now realize that DeFi B is giving, say, 22%, and DeFi A is giving interest of 20%. You have a choice of pulling out your money from DeFi A and putting it into the pool of DeFi B. And now, if 10 minutes later, you realize that DeFi C is giving around 30%. You have an option again of pulling out your resources and putting it into DeFi C. So you could do this repeatedly and you could make more or generate more value for your money. Now, what would DeFi A, B, and C do to encourage people to come and put more resources? Because the more available the resources in the pool, the better for that DeFi, because that's the only way people can come and borrow from that DeFi. Because no DeFi wants to go dry. No DeFi wants to go without having enough resources in their pool. And by so doing, they encourage much more better value or interest for their money. And when they do that, people are willing to put in money into the various DeFi A, DeFi B, or DeFi C, as the case may be. But now, as a result of all of this, People started, instead of keeping their Bitcoin dormant or keeping their money dormant in some places or keeping their financial resources dormant in some bank, they decided to just put into this pool and earn some form of interest from it. But while they are earning those interests from it, something now came up 4 months ago. What is that thing that came up 4 months ago? It's called yield farming. Now, yield farming became a concept that became popular 4 months ago. And the first yield farming we got to know about became the likes of YF1. You probably must have heard about YF1 in the past couple of weeks. But though, for people like me, I got to know about yield farming from the earliest time. So I started looking into what yield farming is as sometimes in early part of June of this year. Now, the founder or the person who developed the concept of yield farming is called Andre Cronje. Andre Cronje became the guy who built the idea behind yield farming, and that is even what is causing the buzz, not necessarily DeFi. All right. So what did he do? He decided to say, why would people be moving money between one DeFi to another DeFi to another DeFi? What about we build a smart contract that would automatically be moving the money itself between one DeFi to another DeFi to another DeFi, as the case may be, so long as at the end of the day, the DeFi is able to maximize return. So it's like putting it on autopilot. Now, let me draw us back to the traditional banking system. Now, some people go to put their money in the traditional bank for fixed deposit, and they get some certain interest after 1 year, or depending on what tenor they want to put their money in the bank. Now, but there are other set of people who don't put their money in the bank. Where do they put their money? They put their money with hedge fund people. Now, who are hedge fund business or hedge fund managers? Hedge fund managers or a hedge fund business in general are those kind of people who want to bring higher interest for their clients. And the people who normally can afford the service of a hedge fund business are high net worth individual. Now, you cannot go to a hedge fund managers and tell them, please manage my 10,000 Kenyan shillings. He'll look at you like you're crazy because his charges are already more than that. All right. So those who can afford to go make some money with the bank will just keep their money in the bank and put it and get fixed interest from the bank. That is the traditional style we know as of today. Why the high net worth individuals, the multi-millionaires and billionaires, don't want to just keep their money in the bank? They keep their money with a hedge fund manager. And the duty of a hedge fund manager is to look out for which of the projects out there, which thing in particular can bring better return for this billionaire at the end of 1 year. So a hedge fund manager can come back and look at one of the most lucrative stocks, something like that, something that has to do with better return than whatever that is obtainable out there. That's what a hedge fund will do. And the hedge fund guys will take that money from the high net worth individuals like a multi-millionaire or billionaire and go and scout around for anything that can give them better return than what they would have gotten if they had kept it in the bank. Now you see, the bank gives interest, the hedge fund guys give interest, but the hedge fund guys will give better interest than the bank. And what is yield farming doing? Yield farming is kind of replacing what the hedge fund guys will do. DeFi will give you better interest than what bank will do. Yield farming intends to give you far more better interest than what the DeFi would have done. So the yield farming, or the farming concept that you've been hearing about that is making the buzz, that is causing so many uproar or hot topic right now, is technically not targeting the bank. They're actually disrupting the hedge fund industry. The most popular hedge fund business we know in the world as of today are the likes of BlackRock and Fidelity. Now, this is not a personal attack again to any of this industry, but I'm saying with the aid of blockchain, we are now decentralizing the entire concept of what a hedge fund industry will do, right from the comfort of their home. Now, what is the benefit of disrupting the hedge fund industry? Before now, the only people who can afford the service of a hedge fund business are people who probably the government or the authorities see that you must have some form of high net worth of up to $200,000 equivalents per year, maybe. Now, in some country it might be higher, in some country it might be lower. All right. Now, for the common man out there, it's not everybody who can afford to earn $200,000 per year. There are people whose entire earnings for the entire year might not even be up to $1,000. But can they participate in some form of service of what a hedge fund will be? Meaning, can they be able to also get better interest in their money, unlike going to the traditional hedge fund guide? Yes, absolutely. Today we can do that. And that is one of the concepts Andre Cronje was able to disrupt